Hello, welcome to Allgen. This is Jason Martin. Today is February 15th. Happy post-Valentine's Day. So I wanted to take you through some of the events that have been going on with the market over the last month or so and show you kind of where we think the market's going and some of the things that we're focused on right now. In the short term, after a big drop at the end of last year, the market has now rallied back up and have one of the strongest Januaries in a long time. So that was encouraging. In fact, if you see right here, the market took a big hit. This is at the end of 2018, beginning of 2019. Right here, you get a rally in the market that takes us up now. So now what we're focused on after this rally, this strong rally, and after the even bigger pullback at the end of last year, is now from a short-term perspective, you're coming up against something significant in technical analysis. And it's called the 200-day moving average. So right now we're rallying back up to that 200-day moving average, and this should act like a ceiling. So if it's unable to get above that 200-day average, then that will be like a ceiling where you can't get above, and it could cause the market to go further down. If it breaks above that 200-day moving average, it could mean that we could go even further to the upside. So it's something we're watching very closely. In fact, if you just kind of look how the 200-day moving average works over the last 5 years or so, you can see this is the S&P 500, and then as you come down and touch off that S&P 500, it acted like support. But then when it broke down below it, then it went further down. And so you can see as the market goes back up, it had a difficult time breaking above that 200-day moving average, then it went back down. Then finally when it rallied and went back above it, it started up in this new long-term uptrend. That was 2016. And then every time it rallied and went back down to it, it acted as support. So the 200-day moving average, when you're above it, acts as support. When you're below it, it acts as a ceiling. So now you fast forward all the way to 2018, October of 2018, when the market started to drop. It went down below it, broke down, and then that's where the market went really low. In fact, from the top to the bottom, it went down 20%. And now, as you can see again, we're rallying back up to that 200-day moving average. So that's something we're watching very closely. Another thing that we're watching is sentiment. So sentiment is very important, and what sentiment really means is what is the feeling of the market. And just from a contrarian perspective, really you should try to do the opposite, kind of what your average Joe is doing, okay? And you should try to emulate or do the same as what the smarter or more the money that's in the know. So there's a really good chart put out by a sentiment trader called the Smart Money, Dumb Money Confidence. Okay, it's not our words, it's their words. It's not meant to be condescending, but what it is, it's meant to say the smart money being kind of the hedge funds, the big hedge traders, the pension funds, the people in the know, and the dumb money would be the people that just kind of, this is a hobby for them. They just kind of go by what they hear in the news. They don't do any really significant research. So the way it works is when the dumb money is very optimistic, the smart money, or what you should be as an investor, you should be concerned. And the opposite is true as well. When the dumb money is very pessimistic, that could be a good opportunity to buy. So kind of if you look at this chart, if we go back to the end of 2017, when the market was really strong, going into kind of January of 2018, where the market initially peaked, you can see the dumb money being right here above this dash line. Above that line means it's overly optimistic. Okay, so when it gets above that line, then that you should be a little bit concerned. When it goes below this line, that's usually a good time to buy. That's the line that says they're overly pessimistic. So as you can see here, going into this market high right here, the dumb money was overly optimistic. The market fell. When it hit this low, the dumb money got overly pessimistic, which then the market rallied again. So that's something we watch closely. There is no chart or there's no indicator that is right 100% of the time. But this one does give a lot of good clues over time. So you can see here, as the market really started to fall, kind of fast forwarding to more recent times, this is October of 2018, this is the big drop, you can see the dumb money got very pessimistic. In fact, one of the most extreme levels of pessimism last year on December 24th, Christmas Eve. And actually, coincidingly, the smart money became overly optimistic at that time. So that ended up being a great time to buy, at least for the short term. Now, fast forward to where we are right now, dumb money is once again overly optimistic. So we should be a little bit concerned about that, something that we're watching for. We have been mentioning since last year that we believe the market is kind of ending a long-term cycle. The economy is ending a long-term upward cycle. The stock market's ending a long-term upward cycle. And potentially we're going to have a little bit of rough times kind of later 2019 into 2020. So we've been using this rally in the market to go a little bit more defensive as we kind of position ourselves for what we believe is going to be a difficult time in the market. And the reason we believe it's going to be a difficult time, just to kind of give you a quick story, if you will, of how economies work. All right, so let's go back to kind of 2008, 2009. Credit crisis, markets falling like crazy. The Federal Reserve, what they do to kind of stimulate the economy is they lower short-term interest rates. Okay, so they did that. When you lower short-term interest rates, that means the market, it's easier to borrow, it's cheaper to borrow, it's a way to position the it's the way to get the public to be able to kind of borrow and invest in their company, borrow and invest and buy a house, buy a car. So the Federal Reserve lowers interest rates to stimulate the economy, right? Okay, so that happened, and then you had the Federal Reserve take really unbelievable measures in really printing money, or what's called quantitative easing. Okay, so you can think about the quantitative easing like steroids. You've now made the conditions a lot easier for the market to grow, and you've pumped some steroids into it as well. So that was kind of 2009 through 2014, coming out of the credit crisis of 2008, and that allowed the market to really gave a shot in the arm to the market, and it's rallied up. So now fast forward to kind of 2015, 2018, the market's starting to move up on its own at a pretty good pace, and then what happens is the Federal Reserve starts to take away the steroids. Okay, so they slowly did it. They didn't do it all at once, and now they've really reversed it. They've taken away all the steroids. You're on a detox program, and so what happens to the market or to someone's body when they've gotten through a bunch of steroids, and now all of a sudden you've taken them all away and you're detoxing? Well, in general, the person who's working out with steroids gets really big. You take away the steroids, you go on a detox, and then they deflate, they're weak, and it takes a long time to kind of get all of that bad stuff out of your system. So we're in that process now. We're in the process of reversing the quantitative easing, reversing the printing of the money, and we're in the process of now the interest rates are up, have gotten a lot higher from where they came from, so that's making it more expensive to borrow. There's a lot of companies out there with a lot of debt, so if the interest rates go higher, that costs more. And also something that just came out this week is the JOLTS report. That's called the job openings report. That hit a new all-time high. That sounds like a good thing when job openings are at an all-time high, which from a temporary standpoint, that is a good thing. However, unemployment is near all-time low. So you have this huge demand for trying to hire people, and you have a very small pool of people that are looking for jobs. So what does an employer have to do to bring on a new person? They have to pay more. So that means wages increase. So you have interest rates going up. That means more to service the debt, and then you also have wages increasing, more to service to pay for your employees. That starts to eat into the profits. So that's how that cycle works. And right now we're kind of towards the end of that cycle where interest rates are getting up, wages are getting up, it's more costly for employers, and that starts to cause companies to make less money. So there's a lot of other things going on, but that just kind of gives you a general kind of cycle of how the economy works. So I hope this helps. Obviously, we're always looking at the markets and the different indicators and the economy and everything to really kind of try to not only grow our clients' assets, but I think right now it's more important, and it's in our philosophy to manage risk as best as possible and protect our clients' assets as best as possible. So I hope everyone has a great day, and take care.